All right, here we go.
Yep.
All right, so let's look. First of all, we always like to look at the S&P. So just to recap, this week we're having more turmoil in the stock market, not stock market, but the banks. We had a decision by the Fed to increase interest rates. Everyone expected it on Tuesday to be raised 25 basis points. And that's another example of buying the rumor, selling the news. So it was a 99% chance, according to the futures, that the Fed would raise the rates. Let's see. It was February 24th. Okay, so it was right here when they made the announcement. And as soon as they made the announcement, it was rallying for the first couple of up until that announcement, and then it sold off. So that's a good example of buying a rumor, selling the news.
But I was surprised that it surprised because everyone was kind of expecting it to rise, right? Some expected to fall because of bank issue, right?
Yeah, so it seems like all the issues with the banks, they're deflationary. So they're going to tighten their standards. They're not going to lend money out as freely as prior to all this happening with the banks. So the Fed was saying in this, I think it was the 22nd, they were talking about this whole situation with the bank crisis, and they said that the natural tightening of banks is like raising rates. So the banks are doing part of the job for the Fed, and that's why the 2-year and 10-year are going down. So that means so right now let's look at the real-time 2-year. It's down a lot from last week, and 10-year. So, and right now the Fed is at 4.75, so it's 1 whole point above where the target is. So the Fed probably is not going to raise rates anymore. So we were waiting for that for a while. You know, when is the Fed going to stop raising rates? I think it's now or close to it. So so it seems like the banks are going to collectively help slow the economy down by not lending as much or making it harder to borrow money. So anyway, the interesting thing that happened while the Fed was giving their speech, the Treasury Secretary Janet Yellen said that there is no implicit backing of every bank. And whenever that happened, all the bank stocks went down 10% again. So we still have the crisis in the banking world. And the important thing for us to keep in mind is, how does this affect the stocks we're following? And, you know, does it make sense? Does it even affect it? And what will happen if we end up having a sell-off? You have to say, well, does that affect the 5-10-year time horizon for, you know, the earnings for these stocks we're following? So I don't know. It's right now. It's the end of quarter window dressing right here. So end of quarter window dressing is like next week. So that's usually good for stocks, especially the ones that have done good so far up until this quarter. That's most of the tech companies basically rallied this quarter. So let me see. What else do we have to look forward to? Earnings are going to start again, starting with the banks, and so we're going to May is more of the tech stocks are going to be reporting down here, and then the banks start reporting in a month or so. So we have to look. That's why we don't have March is pretty much there's not much going on right now for earnings announcements. So it's a pretty boring month, but it's traditionally a good month. So this is a non-standard time. This time is not. We can't predict anything now. All right, so let's get our talking points. S&P is around unchanged since last week. We went up, we went down, but we're right back where we were. We always say Fed never fights market rates, and I just showed you the 2-year and the 10-year. They're down a lot since 2 weeks ago and 3 weeks ago. So it's down another 3 to 7% this week. So it looks like through the banking crisis and the Fed raising a little bit more this week, we're done with that. So we've been saying for a while, whenever the Fed's done tightening, what worked, then we'll pretty much get back to normal. However, one thing that I think, Matthew, did you tell me last week that as soon as the Fed's done tightening, you have a lag? No, Jake was telling me this. There's a lag. So when the Fed's done tightening, it takes 6 months to actually realize all that in the economy and all the earnings in the stock market. So that's just, a lot of times whenever the Fed's done raising rates, that's an indication that for the next 6 months, we're going to be flat to down maybe, just because of that lagging effect of the interest rates on the economy. So let's keep that in mind. Now, for me, I'm a long-term investor, so I know this is a flat to maybe down period for the stocks that I'm holding, but probably after, a year or so, we'll be back to normal. Okay, so you see, we still have this really high yields in our checking accounts, in our CD rates. That's a huge option for some investors who need returns, and this is they're getting better and better every week. So you see,
you said checking account. I don't know if that's true, but there are savings accounts available with high rates.
Okay, we were just
I don't know if
talking.
checking. If you've got a checking account somewhere that has good rate, I'd be interested.
Right. So I guess you had to do some manipulation of where you keep your money, but it's pretty easy these days to put it from a checking to a savings, but it's a big difference, right? 0% versus 4-5%. So you see. But right now is, for the next month or two, this is like the peak rates, perhaps, that you're going to get and secure in a secure CD or long-term bond. So if you don't have that part of your portfolio together, now's the time to start looking at that, because up until this year, we haven't had anything. We haven't had a good place to put money for a fixed rate of return, and now all that's coming to fruition. But I don't know how long that's going to last. We might have a problem like 1970s where we got 10% inflation, and then we'll have more higher yields. But I think this is basically as good as you're going to get. So if you're laddering like Mark is, your CDs purchases, you would buy 5-year CDs, 10-year CDs, maybe 2-year CDs, and then once they mature in 2 years, then you might have a better option to reinvest those CDs into something else. But
we've been having T-bond, treasury bond offer 7% up to recently. Not now.
7%, really?
Couple of months back I checked. So we've been having money parking vehicle there, right?
You see the treasury yield. 2-year, 10-year. Wow, look how far that's gone down. Okay, so I guess we don't know anything about this chart, but look at this right there, this level right here. This is pretty much a support level for this 10-year, I guess. And we went down, this is probably a really big fall. I don't know. I don't know anything about treasuries. I guess I can't really see anything helpful here. So I'll stick to the stocks because I know that a little bit better.
Yeah, so I would just compare that with the money market and stuff. Wasn't compared to the stock, like where you park your money.
Yeah, I guess I don't have that option. All my money's invested. So, Matthew, you knew a lot about that. I guess money market's probably the most liquid, best option right now.
Yeah. So the advantage of money markets is that there's no there's no capital risk essentially. There are times that they've broken the dollar, but I'm not concerned about that right now. But they adjust to rates very quickly, which is good on the way up. On the way down, that the same will be true. That the rates will drop, at the same rate quickly. So, but that's where I keep my kind of emergency money, money that I am going to need to spend to, in the next 6 months, or I'd want to have that option. Is a money market fund. It's very easy to move in and out of, and there's no risk of loss essentially.
Right. I remember in the year 2008, I had my money in a money market in Countrywide, and they ended up going under, and I wired it out right before they went on. It was financial crisis, one of those companies that actually didn't do very well. But you still have a problem with money market. If you're really concerned about that, $250,000 is the limit for insurance, FDIC insurance.
Yeah, so I guess I'm interested in that. So I keep mine at Vanguard in like a federal money market account. It's not like I don't think there should be a deposit in terms of it's not insured the same way, but it shouldn't also be at risk if depending on how those money markets work. It's an asset. It's not a demand deposit. I don't think.
Anyone know the money markets fund we have in our 401k is covered by FDA?
I don't know about that.
We have money markets, right? I actually parked some money there, kind of wondering with the recent event with risk proof.
Well, I think what you can do is you can call the what is it? ING? No. What is the name of the company we work with? Voya. You can call Voya and ask them, and then they'll tell you, because it's actually a mutual fund. It's not. It's like some kind of fund. It's not.
Yeah, money market fund.
Okay, yeah, there's a difference between a money market account and a bank and a money market mutual fund. I guess what I've been using is a money market mutual fund through my broker.
Oh, okay.
So those are slightly different things. The one at your bank, a money market account at your bank, will have FDI insurance. Money market mutual fund is more like a bond, a very, very short term bond fund or something. But it doesn't have the price doesn't go up and down, right? It's just interest.
So it not covered by FDA, right?
FDIC, yeah, yeah, but it's also not a demand deposit, so it's more like a bond fund, yeah.
Yes.
Okay, so here are the big news stories of the day. Let's look at this breaking stocks making the biggest moves. Block. I don't know how to pronounce it. So we have another European bank, Deutsche Bank. It's basically has some funding problems where the amount to insure their debt is going up. So it looks like this banking crisis is not going away anytime soon. And we just have to make sure we see if any of our stocks are affected by this. There was a story by a couple people. We have $1.7 trillion in unrealized losses. So I don't know if you know anything about unrealized losses, but I'll show you real quick. If you buy a let's say a 5% yielding bond, and you buy it at par, that means you buy it when it's You buy it apart, and then you pay $100,000 for it, and then the yields go to, let's start with 1% yielding bond. That's more like what happened last year. So the bank buys a 1% yielding bond. They're going to hold it to maturity, 10 years, and yields go to 5%, to 6%. Let's say the treasuries. So that $100,000 that you initially paid for it, you now have competition. So people will not pay as much for a 1% yielding bond. So that $100,000 bond, if you hold it to maturity 10 years, you'll be paid back maturity. You'll be paid back $100,000 plus 1% interest per year. Yeah, that's what the banks were counting on when they make these purchases. But if yields go to 6%, let's say, then the par value of that goes down to like 60,000. Okay, so if you had to sell it right away, you'd get 60,000 for that. But if you held it to maturity, you'd get the same amount. So hold on for a second. Hold your horses. Hold your horses. Hello? Yes. Oh, good. I gotta call back later. Thanks. Sorry about that. Okay, so this is an example of an unrealized loss. The same thing as if you buy a stock. If you buy this stock for 100,000, the total purchase price, the 100 shares, and the price of $100 per share. If that stock goes down to $50 a share, you can sell that for $50,000. So that's an unrealized loss of $50,000. So what you have with these banks is that if you have a run on deposits, so people want to take their money out, the bank is forced to sell the bond before it matures. So they're taking this loss, this haircut, in whatever the value of that bond is. So that's called unrealized loss. And we have in our banking system $1.7 trillion of this unrealized losses. Okay, so a lot of the big banks have these losses on their books, and the Fed actually made a way to temporarily put some of those losses on the Fed's balance sheet, and that's what this window is we heard about last week that kind of saved us from a run on every regional bank. So, and you also have interesting thing about stocks, like Warren Buffett and his company Berkshire Hathaway. They have unrealized gains, which is something that's like the opposite of that. If you buy a stock for $100 and it goes up to $1,000 in value, you have an unrealized gain, and the corporations now have to realize that gain as income. We don't, not yet. But I just wanted to say explain what an unrealized loss is. And right now, there's a really big problem where if enough people got people scared and they made a bank run on Bank of America might have a similar issue. I mean, I don't think it'll happen because you have so many depositors, and it's much stickier of a situation than Silicon Valley, which had maybe less depositors with maybe 50 billion apiece. It's easier to get 500 people out than a big lot of people. So anyway, I just want to explain to you what the unrealized loss was and how it affects the companies now. We still have we still have a lot of unrealized losses, but the Fed allows temporarily transferring some of these losses in this window. All right, I just want to get that over with. But we still have a problem right now with the European banks, where they're in worse shape than America for sure. So we're still in a crisis, and we still have the possibility of going down in a crash situation. So if we look at Dan Niles, he gave a talk this past week, and he's still talking about this $3,000 fair value for the S&P. That's around 20% lower than where we're at now. So we'll keep that in mind. You know, if we have a panic or something, we might go down to that level. But the stocks we're following are pretty stable, and they'll probably go down to a PEG ratio of 1 if we ever have that happen. But we are definitely in a crisis when we're raising rates, and we're the interesting thing about what we're doing now. The Fed updated the balance sheet just in the recent week or two. 2/3 of the tightening that's been done has been reversed with all this banking open window. We had another 160 billion this week given to banks. So our number 2 Fed reducing balance sheet by 82 billion a month, that basically stopped. We're adding 300 billion per week right now. So we're almost undoing all of that, and that is like reducing rates. So it's very uninflationary. All right, no, that's inflationary actually. Whenever you're increasing the money supply, that is worsening inflation. Why do we have to figure this out? I don't know, but it all affects what you pay for stocks in the end. The interest rate, if you have a 6% interest rate, you're going to be paying maybe 20%, 20 for a 20 PE in the S&P. But if you have a 1% interest rate, then you pay 28 PE for a S&P earnings. So we haven't figured out that formula, but it has a lot to do with investing and how much people are willing to pay. All right, now that that's over with, that's good to know that, but it's really confusing. Right, what other talking points do we have here? Okay. Oil is unchanged since last week. For a second. So it looks like we're going into recession. If that happens, we'll have this $50 to $60 oil because there's not as much demand. What else can we say here? Okay, this was very interesting. I didn't know this was happening. I knew we were up for that one rescue of Silicon Valley. I knew that was 300 billion, but we added another 300 billion after that. So it's definitely a crisis. Let me see. Okay, the dollar is continuing to go down. So that's good for multinationals because companies like Apple or Google that make sales overseas, that's worth more money when the dollar goes down. All right, so let's look at these sectors and see how they're doing. We expect the bank sectors to go down a lot today. Let's see what is sector ETFs. Semiconductors are down the most. Financial is basically not down a whole lot. Oil is down. Okay. So regional banking is rallying. Oh, this is up one day, down another day. Okay, so regional banking is up the most. Utilities, consumer staples, these are safe sectors. S&P, bank. So banks and conservative companies, the more risky ones with the higher PE ratios are going down the most today. So it's a flight to safety today. Okay, so that's what's happening. Let's look at the market movers. What companies are going up and down the most? Okay, so Activation Blizzard, they were a company that Microsoft tried to acquire, but they were trying to get approval in Europe, and they finally gave indication that they're going to approve it, so that's why it's up a lot. These are energy companies, conservative. These are utility companies. So utility, banks, and drugs. Utilities, and so those are conservative types of stocks. The ones doing the worst, there it is, Enphase Energy up and down 5% every day. It's one of the most volatile stocks we're following. Solar Edge. Okay, all these have high PE ratios. So I guess there's a flight to safety. You can see it from that. And, all the ones with high PE ratios, again, in the NASDAQ. Every one of these has PEs of like 80 or 100. That doesn't follow, the interest rates are going down. That's usually good for high PE ratio stocks. But for some reason, there's a flight to more conservative stocks that pay a dividend, and that's the ones that are going up today. Okay, so the Dow, all right, can't get anything really good from that. Okay, these are the ones that are going up the most are conservative companies. So Amgen, they're a drug company. Coca-Cola staples, things you need for the home. Procter & Gamble, Tide, and Walmart. These are things that'll consistent demand in bad times and good times. And the ones doing the worst are the ones that are more cyclical, the ones that go up and down with the economy. If people have more money, they'll spend more, and if they don't, in a recession, they'll spend less. Okay, that's a good lesson learned from that. Let's look at what's going on in the news. We had a short call. This Hindenburg Research, they're just amazing. They're finding companies that are doing things illegal, or they're doing things that they're not reporting correctly, and then the stock goes down 20% in the day they report something. So they said that Block, another name for Square, they're allowing illicit transactions, like for instance to buy drugs or something using their platform, and they're monitoring some of the money laundering. So that could be really bad for we're not following anything that they would do a research thing on. But whenever, let me see. So that's why Square is down a lot. I'll go a little bit later on. I'll explain how dangerous Kathy Wood's approach to investing is. We see that Block, Coinbase, they're down like more than 50% recently. As they're going down, not only they're declared a stock that's doing illegal things, but Kathy Woods is still buying them. As of yesterday, she's still buying more Block, more Coinbase, and they're down 90%. And that we were talking about Kathy Woods like a year ago or 2 years ago, and is she a hero or a zero? And way back when, we were saying she's a zero. And these stocks, they don't have earnings. They have total addressable market, perhaps, but they're turning into stocks that are not very good in this environment of rising interest rates. And she keeps buying more, which is totally irresponsible. I don't know. This is very dangerous. I would stay away from these.
I think she might be doing the dollar costing of her stuff.
Well-
But at the same time, I think this is just a phase that she believes, because Square and Coin, they both are good companies. It's just that they are in a mess right now. And because Hindenburg said something that goes against Square, as Hindenburg, and keep that in mind, Hindenburg is not always 100% correct. They have, they also are doing business as well. They do do a lot of short selling as when they create the report, because that's how they make money. So they blame one of the company, they do the research, and then if you look at it, then that way, there'll be many companies, that Hindenburg can research, but they target certain companies and then they go for it. I think there's nothing wrong if she buys something, if she's doing a dollar costing of her portfolio of funds. But at the same time, Greg, there should be some limit to it. But we'll see. Because if you have observed Coin went high up after it went in like if you look at it in the last 2 months, look at Coin, you will see that how much it went up compared to what it was in December or so. So yeah, Coin. I have a Coin account in Coin. See, Coinbase was at one point was $30. Even though it was $200, but at one point it was $30, and then it went up 100% this year.
So what she did was she sell on the rumor and buy on the rumor and sell on the news, right? She sold a big chunk on last Tuesday and then bought it back yesterday. So she pocket the difference.
Well, I think what she's doing, when you have an open-ended ETF, I don't know what this is really called, but you have money coming in, money going out. At the end of the day, you have to, if you have a net money coming out, you got to sell more than you buy, and so you got to sell something. So what Kathy does is she has this list of what her true value of each of these are 5, 10 years, 20 years from now, right? And then at the end of every day, she says, okay, well, we can't get too over our skis in any one of these things. We have to move the money around.
Rebalancing.
Rebalance so that you have the most amount of money towards the things that's going to return the most over 10 years or something like that. So she's doing that. I mean, she's forced to do this buying and selling. And sometimes you got to sell the Tesla. She bought this Tesla yesterday, and now she's selling it. And so it just looks bad because you have to manage your money coming in and out. And but I just think it's reckless to buy stocks that are like Block. It's a huge question mark if they're doing accounting correctly. The next day, just keep buying more. Like
keep in mind that she had a percentage of tolerance in her stock. For example, I don't think she had more than 7% of her portfolio in Coin. She had less than 7%.
Oh, rats. Oh, I had this. But sometimes when I insert pictures, it doesn't. There's a percent on the next. I'm gonna try to find that on the internet.
Maybe
You can order the size. Yeah, find on internet. I think you should find it.
Okay. So ARC ETF top. Okay, there we go. That's better. We have Tesla, Zoom, Coinbase. So we have Tesla 10%. Zoom has been a big loser. People aren't using Zoom like the pandemic. We have Roku. Wow, these are really flaky companies. UiPath, that's a potential metaverse play, but they're not. Metaverse isn't going to be around for 10 years probably. I don't know. These are all really risky. And the 10% in one stock, 8%, 8%, 8%. Wow. Okay, so you can see that, Coinbase, let's see, Block is 6%. So did you hold on for 1 second? Sorry, I'm having some work done on the house, so I had to take that call, but I'm done with that now. All right, so so I'm just saying these are all so flaky and risky. We don't know if these are going to be around in 5 years, and that's why it's really, really important to know what you're holding if you're going to buy something like this. Tesla is probably the only company with consistent earnings in all these.
Total return, do you have that information there?
Total return. Oh, let's do that just for kicks. Let's do ARK. Okay, that's our most famous one. And let's say performance. See what our. I guess if you held this 5 years, it'd break even now. 5 years. Break even. And the S&P returned 14% a year. Year to date, 21% versus 5% in the S&P. Or QQQ, they're probably comparing it to. So it's not, so far she's.
The strategy work.
I don't know. Well, her initial strategy was to act like she was like this smart person who knew more than everyone else. And then she started picking loser stocks that went down, or the things that she bought fell out of favor in a high interest rate environment. And then people lost faith in her, so they started liquidating, and there's less money being managed. So it was just like an endless spiral. We talked about that possibility of an endless spiral, when it started. And now the thing is, right now we have pretty much the end of rising interest rates. So we have an inflection point where people are flipping the switch from maybe safe investments. In the next 6 months, it's going to switch to more aggressive, maybe technology funds. Maybe she might outperform, but it's way too risky for anyone here to be considering. I'm bringing the opposite side of things. Whenever you look at one of these stocks, let's look at her holdings and just pick one of them. Just every one of her stocks is holdings. They have negative in their projections. Let's look at Roku just for fun. We'll go to E-Trade and go ROKU. She looks at for that fund, she's looking at total addressable market rather than are they earning money today? And I wonder why it didn't pull up. ROKU.
The advantage of Roku is actually they have an awesome product.
Oh, you like it? Do you use it?
Oh yeah, the Roku is a great product.
I use it too.
Okay, we're not going to do Roku. We'll do a different one. We'll do Square because it's in the news. Let's see if it's actually earning money. Square. It's not allowing me to do a search. We'll do Yahoo Finance.
And so on the Roku side, so Roku I think has a couple of competitors, which is like the Amazon Fire devices or like the Google Chromecast devices. I'm not sure what, like an Apple TV maybe device would be a competitor. And Amazon is actually been really, I think, cutting back on their Fire team, the team that does the Fire devices and the Echo devices.
Mhm.
I think they've been shrinking that team a lot. That's one place that Amazon's been cutting costs. And I don't think the Google Chrome stuff is well regarded. So probably the Apple TV would be, I don't know what the market is there, but in terms of, I don't know what the financials are for Roku, but in terms of their position in the market, I think that they have a good product in a competitive market.
So the problem here we see just by looking at this, they don't have any. Everything's like NA, negative, negative, negative. Wow, Warren Buffett would not touch this stock. That's for sure.
Yeah.
So even if it was a total adjustable market, wouldn't it be easier just to watch YouTube? You don't have to set up this thing on your TV and you have everything streamed to your TV. I don't know that.
Yeah, I'm not saying I want to buy the stock. I'm just saying that their product, and I think that I think that you can do subscription services to other companies through them, and I think they take a cut then.
Oh, okay. All right. So here's.
I think that their fate is a little bit tied to like a lot of these streaming services too.
So I guess their business model, Roku, you have an electronic station list that people pay for. Like for instance, you'd have CBS reruns on Channel 2. You have, they pay for that, and then they get money for a subscription cost. But look at all this negative. Wow.
Yeah. I'm not saying about the stock. I'm saying about the product.
Okay, yeah. Okay, so you can see that this is like a trough of negativity. There's a good chance of them going bankrupt if they don't turn this around. Kathy Woods, what she's looking at is she's looking at that negative 23 in 2026 and hoping that'll go positive, and between now and 3 years from now, you gotta think that Google will come up with something much better than this. They already have streaming figured out, how to pay content, and they already have a channel on. They have a cable subscription service. I don't know. They have some pretty deep pockets for competition. So you have this is an example of whenever you buy that ETF of. Let's look at one more. Let's look at Teladoc. They were the big hit for the pandemic. People couldn't go to the office. They went TDOC, and they went in video conference to see a doctor. And I don't know how popular it is now, but I'm sure it's not doing as well as it did during the pandemic. Let's look at the earnings. They probably had a big jump during the pandemic, and then, okay, look at that. They earned money during the pandemic. Right after the pandemic, they're starting to lose money. But look, I guess Kathy Woods is looking out. It's all negative. They're getting less. They're losing less money every year, and maybe in 10 years they'll be making money. But the one problem with negatives like this is you could easily go bankrupt, if you don't, in a bad environment, and that's really, really risky. Every one of our stocks is like this. So I'm just
I'm not advocating for ARK, and I don't hold any stock, but I think it depends on when she come into the market and when she get out of it, right? She tend to hold some potential technology stock with bright future, and she also tend to hold some trending stock that she profit on the trending up and down. So depend on when she get into the market and when she get out.
Yeah, but still,
basically she combined a short-term and long-term strategy together.
I don't know if she's doing that well.
Well, she didn't lose money.
Well, she is losing. Her fund is down. It hasn't made money in 5 years.
It's only somewhere percent year to date, right?
Right. Yeah, 22% this year, right? So
she's been doing okay. I thought she lost money, but seemed to tend to be okay.
Right. So this is real dangerous. To each his own. If you're interested in 10-year time frame, it's not going to do well in a rising interest rate environment. Okay, so let's look at go through all my talking points. Okay, stochastics. Right now, we're looking at the S&P chart. You can see right here we talked about the momentum, BAM. This is a momentum. This is the Walter Deemer says we have a certain amount of breadth of up volume, and that triggers higher highs usually. But the one thing that Walter Deemer says, if it goes up a certain amount in a short period of time, probably in a year or two, it's going to be up like a lot. But it could go down 20% before it goes up a lot. So that was one of the things he said in his comments. But we do have an up channel here. We have higher highs, higher lows. But we are following this trend line down. So we're like hugging that downward line. So, in a sell-off, we'll probably go down to here because we're still, but let's hope that right now this is pretty much a bottom. If we go up to here, there's a very good chance we're going to keep going like that. So it's always good to look at the big picture. There are two options here. We could continue to go up in that upward channel, or we could resume our downward trend. Let's hope not. Okay, fear and greed index. We're more fearful this week than we were last week. There's a lot of people afraid of the banking crisis. If there is more defaults, there's 1.7 trillion in unrealized losses in the banks. If that turns into a panic and we have more bank failures, all bets are off. All the stochastics don't work. What we're going to do is we're going to start going down to points of support from the past. So if we look at planet, let's go look at the S&P. SPY. So we have the ingredients for a sell-off. We have people afraid of rising interest rates. That's an unknown. The market hates unknowns. And when we have potential bank failures and people getting scared about, where they can keep money in a bank, that's a cause for a crash. For me, it's not even an option to sell my long-term holdings because I know immediately if I sell, I have to realize gains on all those. You lose 20% as soon as you sell something you've held for a long time. So let's look at the S&P. And if
That's 20% of your profits only?
It depends on how much
Profits,
money
right?
you make.
Right.
Yeah, of your profits. Yes. So if you have a big profit in a stock, like say if you have $100,000 in gains, you have to realize that on your taxes. So if you make $100,000 a year, and you make $100,000 gain, then that you have to pay like maybe 20% tax. So you lose 20,000 and you end up with 180,000, right? No, anyways, my point is you have to pay around 20% in an upper tax bracket for capital gains tax. So so you got to find something that at least you think if it's going to go down 20% from here and you can get it at a better price, or maybe that stock has stopped growing and has no potential, maybe then you consider, scaling out of it. But I think this situation with the banks, I think it's going to be resolved within 6 months. So maybe 6 months, a year, all the stocks we're following, they're going to be back to normal. Because the interest rates, it'll take at least 6 months to a year for everything they've done for interest rates to affect the economy and all the stocks and the earnings. So but I'm patient like that. I can handle a 20% drop. So if we look at the S&P, we have support right here at 357. We have support right here at 383, 82, wait, 376. So anytime it drops and it holds, that's another level of support, another level of support. And of course, this is the pandemic low of 200 and something. So that's kind of what you have to keep in mind. In almost every the stocks follow the same pattern. Just whenever you look at a stock, the same levels of support. So let's look at the because we were talking about it just for kicks. Let's look at SQ Square. Whenever they had that news come up, I bet you it went down to past levels of support. So look right there, 60. See how it went down to here? That was Christmas last year. And we went right back down to that level, like right now. So we had this level, which is 51. That was October of last year. So if this square breaks below 51, then we have the pandemic lows of 40. That's how a stock will free fall, and it usually stops there for a while. And if that doesn't hold, then you have to go back. Whoa, you got to go back to 2017 when it was $35 a share. So I'm just making that point with an example, but just have to keep that in mind that we have all the ingredients for a sell-off, and the stocks that we're following, they're going to be robust and pretty much won't be that affected by this banking crisis that we're going through. All right, so VIX is it's up 8%. We had a lot of volatility. We're basically flat with the S&P. Here's an example of a stock that's been going up for a couple years now in a straight. This is one of the only consistent stocks that are doing well in this environment. Pepsi is raising their prices, and with inflation, and they're not losing market share, and they're selling the same amount or more. So they're in this uptrend. That's one of the stocks that are doing good. We already talked about ARK. Here's some an article, our best long-term picks. Now, Morgan Stanley suggested 30 high-quality stocks to buy now with this in mind. He said 30 for 2025. So we've been following these long-term picks that the mutual funds bought 20 years ago, 10 years ago. They're still holding, and we follow them. And he made a list similar to that. And a lot of our stocks we're following are in that list. And these stocks have stronger earnings picture next year. Easing high inflation, this is the environment that we're in. Pent-up demand in investments, and recovery in global economic growth. So these are all stocks that'll do good in that environment. And he said they're based on sustainability, quality of the business model, and ability to increase their competitive advantage. Okay, so the stocks we saw with Kathy Wood's ARK, it's not even close to being fulfilling any of these because they're not consistent, they're not sustainable. Get out of the pandemic and half those won't work. So let's look at those. And this is the list of the 30 stocks. And the ones we've been following, I highlighted in yellow, Alphabet, Costco, Eli Lilly, Exxon, JP Morgan. So he likes, 3 of these are the big credit card companies, MasterCard, Visa, and American Express. And he likes those. What I did for each of these, why they would be a good company long term. And the credit card companies are good because there's consistent demand. When you buy something, you're protected. That's one of the biggest reasons to go with a Visa, MasterCard, American Express. Someone messes and they charge you something for something, you can always complained at a credit card company, and the other companies don't have that. I tried to get my money back in PayPal. It was like really hard. So, but and the other thing is, we have a switch from 90% of transactions in the world are 90% of transactions for credit cards are no. 90% of transactions in the world are cash, and there's a switch from cash to credit cards, and these companies still have a lot of room to grow. And the three credit card companies, they make money on as a toll collector. So if you, whether something's expensive or they'll sell less of it, but they'll sell for a higher price, in the end, they're not going to do that bad in a recessionary or a inflationary environment. So it's Eaton Company. They operate power management company, that power management, and that's different industries. One is aerospace, and they sell parts to defense contractors and airplanes companies, and they have vehicle segment that sells to auto manufacturers. So I looked at the main customers, which are pretty reliable. You have building manufacturers. See if they're companies that want to upgrade their buildings to be more ESG, environmental. You have a defense industry that's getting money from the government, so that's pretty secure. Car manufacturers, a little bit flaky recently, but still, that's there's a lot of demand for cars these days. But it's economically sensitive. That's kind of the bad part. So as the economy goes up and down, they're affected. So I did a look at their earnings real quick. They're growing at like 10% a year if you average it all out, and their PE ratio is 20. So if you divide the PE ratio by their growth rate, that gives you a PEG ratio of 2. So they're very rich right now, but they're consistent. You can see that their earnings are consistent over time. You don't see any red in this diagram, and that's good. And so that's why companies are sometimes trading at a premium, twice what they should be, because of their consistency, that you can buy it and hold it and know they're not going to have this red negative numbers because there's a consistent demand for the product. So $80 a share. If we have a sell-off in the stock market, I bet you it would go down to $80 a share because let's look at Eaton and see what they did in the last crash. ETN. So Eaton, they do the building. So all buildings, creating building permits and that kind of stopped during the pandemic. So there was a big fear that they would lose some of their business. Let's look at, this is 2020. It went down to, look at that. It went down to $64 a share during the pandemic. Wow. So that's very close to our, PEG ratio of 1. It would be PEG ratio of 0.7 at the worst of the pandemic. So that gives you an example. We have to keep track of these good stocks, so whenever there is a sell-off, that you're ready to throw our cost into them for like a long-term hold. So they'd grow at 10% a year, and they pay a dividend of 2%. So total return is like 12%. So that's an example of one stock there. Let me see. I like to go through one more thing. So right now their stock is like at an all-time high. They're very close to that. So that goes to show you that they're resilient. They have a steady demand for their product, and they're not really affected by the potential of a recession. Okay, so their PE, they have these two good numbers, 11 and 14. We're looking for at least 13 on profit margin and 13 in return on equity. Okay, we'll go through this one and then we're done. Leon Cooperman, he's one of the smartest hedge fund managers around. He says that the U.S. is going through a textbook financial crisis. He's been warning about a bubble for years. We're going into a bubble. All this Bitcoin, he doesn't like a lot of the speculative tech stocks. He likes oil right now because the price of oil is down. It has a low PE ratio at high dividends. He likes stocks with current yields of 5 or 10%, and he still says things are overvalued and they can go down another 20%, and that kind of matches our Dan Niles estimate. So here's another quick article. History suggests these S&P stocks are perfect to buy and hold forever. One of them is Costco. We know that they have most of their money coming from membership fees, which they can increase, and they still have a retention ratio of like 99% satisfaction, and they renewal people that renew. Cintas, they have a niche in selling, renting uniforms, and no one else really does that. Otis Worldwide, they make elevators. They used to be part of UTX, but they were spun off. The interesting thing about Otis is that Otis makes most of their money through maintenance of elevators. So that like once a month they go out and they oil the elevator, but they charge for that. And who else is going to fix an elevator? Who else would you trust to service an elevator? So that's consistent, steady growth. So that makes sense. I guess in a time where there's a recession, this stock will go down because of perceived, companies are not building as many office buildings. There's no elevators, but that'll be, we'll go back to look at that after we have that problem. In Tractor Supply, we've been following this a while, and I'll skip the Tractor Supply because Matthew brought this up a while ago, and it's turned out to be one of our best stocks. They have 25% market share in animal feed. I didn't know that. And they have this neighborhood rewards program and recurring purchases. So you're always going to be buying your animal feed from the same company. And they have a return on invested capital of 37%. So, and they're buying back stock. So in one decade, they have 20% less stock than they did 10 years ago. And it's reasonable PE of 24. Okay, so I know I ran over my time limit, but thanks for attending, everybody. I hope you enjoyed this talk. I hope you have a very good weekend.
Thank
Thanks,
you, Greg.